and welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investing research, insights, and recommendations since 1970. I'm Chris Preston, Chief Analyst of Cabot Stock of the Week and Vice President of Content.
And I'm Brad Simmerman. I'm the Managing Editor of the Cabot Wealth Daily and the Chief Analyst there. And today on Street Check, we're going to discuss the debt ceiling resolution, whether we've hit peak AI hype cycle, and then what comes next. Before that, we're going to do our weekly Defend the Take segment where we defend the hottest and wildest takes. I'm chuckling a little bit because the S&P is solidly over 4,200. There's no stick save for me.
I think we need to go to this every week. Update on
see how wrong I was. That's
the
week.
Just how wrong you were. So that was that
2
last? That was
2 weeks
2
ago.
weeks ago. 2 weeks ago. Okay.
2 weeks ago, I was hanging my hat on it hadn't closed. It closed, it came down, but now with the debt ceiling resolution well above it. Let's see if Chris can defend a better take than I could, or can find a take that's more defensible than mine was. Chris, your take today: the Fed is not going to raise rates. I think we've heard that from you before. But I'm going to give you 90 seconds. You can lay out as much context as you want. Your clock starts now.
Okay, so this is me doubling down. I said, I think about 4 weeks ago, my defend the take was that after the Fed had just raised rates once again a quarter percentage, that they would not either raise or reduce rates for the rest of the year. They would not change. I got to say I wavered on that a bit in the last week or so, especially when the CME Group's Fed prediction tool went up to, I think, above 70% for June, them raising another 25 basis points. They've since changed their stance there, and now their CME is expecting there will not be a rate hike in June. In fact, the vice chair-elect, Jefferson, came out yesterday. Philip Jefferson said we're planning to skip is a big word for them in June, rate hikes in June. And actually the same word was used by Patrick Harker, Philadelphia Fed president. I think we're going to skip. I think that it doesn't seem like they really want to raise rates anymore. They keep saying we're going to look at the data. We'll see in July. We may not be done. There's definitely members on the Fed who are like, we're not done. I think this all depends on how the inflation data looks, but I think that they really don't want to hike rates anymore. They're not sure that another 25 basis point rate hike is going to do much. I still think they're going to hold firm the rest of the year. No reduction in rates. Sorry, no reduction in rates, but no more raises. So I'm doubling down.
Yeah, I mean, okay. So my first instinct when you said, all right, I'm going to defend the take that they're not going to raise rates again, it's like, okay, well, yeah, we saw this. But the market did have a really significant change in perception as you laid out with those numbers, where it was pricing in 70.4% chance of a rate hike as of last Friday, probably right after our record, something along those lines. It's really tough to know what the Fed does now, especially with the jobs numbers coming in much better than expected. Market is celebrating today, obviously, more because of the debt ceiling than anything else, which I think we need to move on to. But I think the Fed is still in a tough spot, and they're still probably the boogeyman. Unfortunately, I mean, like, they will be until, I guess, the July meeting. Then, if it's going to be a pause, that July meeting is then going to take focus a lot, because if they're going back to like an every other meeting policy change stance, then
they keep moving the goalposts. June and then July. You mentioned the jobs numbers coming in this morning. So when we first looked at this morning, or I first looked at the CME target rate probabilities, it was up to 78% no rate hike in June. Now, since the jobs numbers came out, it's down to 66%. So people are wavering there. It's been back and forth. At least two members have used the word skip in June. So I don't think they're going to raise in June. July. So the same group, CME Group, is forecasting in July a 51% chance that they will raise another 25 basis points. but as we've seen, those percentages are always in flux. So I'm going to say they hold firm, but that really depends on how quickly inflation comes down in the next couple months.
Yeah, and how rogue are the Fed members that are speaking, right? Like we saw this
Yeah,
during the hikes during the rate hiking cycle, where you'd
yeah,
have rogue members come out and say, "Oh, we should have raised it a half a percentage point, or we should have kept them the same." But let's move on to the other subject. Debt ceiling
yeah.
seems
And
like
it's
we've got.
yeah, this is
A,
our big three topics for the week. Yeah, debt ceilings. We'll start off with debt deal. It's basically done. It's all that's left is for Biden to sign it, which I don't, unless he runs out of ink. I think that'll happen. And so crisis averted, right? And stocks are higher than they've been since what, last August or any point this year. They're up above
yeah.
4,200, as you famously, as we know. So there was no, other than a few days when there was, as the deadline approached and stocks did fall 2-3%, they bounced right back as soon as it became clear a deal was going to get done.
Yeah.
Why was this different from the last time this happened in 2011 when stocks fell 15% in a matter of like 3 weeks?
I think there's two reasons that it was different. The first is, this debt ceiling sort of fiasco came on the heels of what's been like an 18-month bear market, right? So everybody's already sold. We've seen people sitting on like institutions on the sidelines. Everybody's in cash. People are largely hedged. There's not a lot to give back leading into that deadline. And then I think part of it is political as well. In 2011, we talked about this a little bit last week. Tea Party was a relatively new political force, and they had some measure of, we'll call it goodwill, political goodwill at least. Now I think people are sort of tired of the highly vocal politics. I think the loudest voices in the room are sort of being told to quiet down and step back, and there's no political will on either side, or political reward for being the loud person that shuts down debt negotiations. And that's on either side, right? Like there's a reason the Democrats didn't come out and speak out against it, and that's largely that they would take the brunt of the blame. Something like 80% of people polled would have blamed the Biden administration and the Democrats in power had we breached the debt ceiling, had we defaulted. So it was so they are incentivized not to speak up and oppose it, and then there's just not the political will to hold the country hostage for the sake of somebody like Marjorie Taylor Greene, or somebody that's particularly vocal about every issue.
Yeah.
I think people are kind of done listening to that. I hope. I don't know. I mean, like,
Yeah, and aside from the politics of it all, I think you touched on this in there. In 2011, this was July 2011. We'd come off of 2+ years of very strong recovery from the 08-09 market crash,
yeah,
whereas now we're at a year and a half basically of a bear market. Even though things have gotten better this year, we're still down in the doldrums unless you invest in mega cap tech stocks or AI, which
yeah.
we'll get to in a second. So I think that's part of why the sell-off didn't really come. I think we've seen this before. They'll get a deal done. There's never really a sign that it wasn't going to happen eventually,
Yeah.
even though it came at the last minute. So that's why there wasn't a sell-off.
Yeah, we kept seeing those breadcrumbs. That's been sort of our takeaway from it, is like, all right, as long as we get the breadcrumbs, the market's going to keep eating those and feeding on those and not gonna correct or super sell off. And then things sort of played out as hoped, as expected, I guess.
Yep. Yeah. I mentioned at AI. Let's move to number 2 in our big 3. That is, so AI, we talked about it last week. It was red hot. Nvidia was up, 26%. Broadcom, AVGO has been up, was it hitting highs? Microsoft's been up all year, driven mostly by ChatGPT, Bing. And then this last week, things have paused. The last few days, at least, things have paused. And then there's been a company like C3 AI down 24% just the last 2 days. Have we reached a temporary peak in AI?
I think so. You and I had talked about this prior to the record. I feel I'm getting psychologically whipsawed a little bit. Like we just saw the same exact hype cycle play out with the metaverse.
Mhm.
Um, this shouldn't be a huge surprise to investors that things spiked and then cooled down. But I think they're becoming aware that now it's time to pay attention to the bottom line, right? I'm glad you brought up C3.ai because they sold off on disappointing earnings. The bottom line matters now. We've sort of squeezed as much juice out of the AI hype cycle as we can, even with Nvidia. We saw them come off like they're still at staggering evaluations, 218 times forward earnings this morning. But below 220, so like slightly improving. But I do think we're past the point where a company simply mentioning AI in a press release is enough to juice returns for for a prolonged period for more than just a day or an hour or whatever.
Yeah, amazing how what a difference a week makes. And yeah, Tim Lutz, who's chief investment strategist at Cabot for a few decades and just retired last year. He used to always talk, and Mike Santillo, our growth investor, talked about there's three phases of a stock's life or company's life. There's the romance phase where everyone falls in love with it, and that's what definitely has been happening with AI. Then there's the transition phase, which maybe we're quickly cycling to that, where things come back a little bit. Maybe not necessarily come back to reality, but people are sort of over it and move on to the next thing. And then the reality phase, and that's when you really see what the truth about just how big AI will be and how big an impact it'll have on certain companies and the economy. And I think maybe we're starting the transition phase, and eventually it'll be based on, like you said, on the reality of what the numbers actually are.
Yeah, I just had a thought. I'm sort of curious if maybe this cycle is abbreviated for AI because it came essentially out of nowhere, right? Specifically Chat GPT and the large language model implementation, right? Came essentially out of nowhere, immediately became the fastest application to be downloaded on like all the app stores,
Yeah.
right? It was reached 100 million downloads in 6 months or I don't remember the exact technical specification, but it became like the most popular web application ever. And I wonder if that sort of accelerated deployment is also shortening that cycle a little bit and allowing us to get that transition phase faster. And the hypothetical investor in my mind is saying, wow, look at all that this AI can do. I can immediately envision a scenario in which this helps me. I expect to see commensurately quick results from business deployment.
Right.
Right. So if you can get a full sense of the tool and you can get a full appreciation of the tool and it's so quick to roll out, you expect quick results. So I think maybe we're shortening that cycle a little bit there.
Yeah. So with AI in a temporary pause, at least, let's move on to number three in our big three, which is what is the next AI? Is it identifiable right now? You had an idea that maybe may not be in the immediate future, but you had one sector you sort of identified.
Yeah. What I want to do is I want to break this down in two ways. My pitch is economically sort of transformative. And then I think you have some sectors as well that you think are going to be maybe more investing results focused,
Yeah,
right? Like,
stop gaps until the next big thing.
yeah.
Yeah.
So the AI, they're talking about adding, trillions to the economy when it's fully deployed. Huge investments are being made. It can replace, hundreds of thousands of jobs, create hundreds of thousands of new ones, right? Like that's economically transformative technology. My pitch for the next AI is quantum computing. The reason that I think that is going to be the next segment or the next technology that becomes economically transformative is because it fundamentally changes how computers work. Existing computers compute linearly. So to get from 1 to 3, you have to add 1, and then you have to add another 1. The same to get from like 1 to a million. You're completing like a bunch of sequential steps. Quantum computing allows simultaneous considerations of solutions to problems. So if you have the number, let's say the result of, let's say you're trying to calculate um, the different ways you can add numbers to get to 4. You've got 0 plus 4, 1 plus 3, 2 plus 2, 3 plus 1, 4 plus 0, right? Quantum computing sort of considers all of those possibilities simultaneously, which makes it very, very good at potentially disrupting every layer of security technology on the internet. It's going to depend. I mean, it's going to require a ton of compute power. Something like the current algorithms that are used to create and secure Bitcoin, you need like a 1.9 billion qubit quantum computer to undermine those security measures in 15 minutes. You could steal all of Bitcoin if you had a powerful enough quantum computer right now, because it solves the algorithms that create security. A lot of them are factoring large prime numbers. It's all mathematical solutions, and quantum compute can really disrupt that. The biggest quantum computer right now, I think, is Eagle. It's IBM's, I believe, and it's like 4,000 qubits. So we're still 5 to 20 years away from the security layer of the internet being potentially completely disrupted by the existence of powerful quantum computers. But from an investing standpoint, quantum cryptography companies, the companies that are right now researching how to future-proof secure algorithms, are companies to be on the lookout for. That's early stage quantum compute that will actually translate to a lot of economic viability. It's like where AI was, 5 years ago. Now, unfortunately for us, a lot of that investment opportunity is going to be made at the venture level or at the startup level or through big corporate buyouts. But if we start seeing quantum security companies, quantum cryptography companies going public, pay attention.
I'm just nodding along like I know like I'm sitting in an organic chemistry class right now, like I pretending like I know what you're talking about. I think Qubit is what really melted my brain. But you may be right. That's a great idea, and maybe that's next up in the hopper. I will give you tons of credit if that's the next big thing in the pipeline, whether it's a year from now or 5 years from now. And I hope you're right. In the meantime, I think I'm not smart enough to identify what's coming right behind AI, but in the meantime, I think something will fill the void, especially as the next bull market returns, whenever that may be. I think some of the more beaten down sectors, growth sectors, will lead the next charge. I think biotech, as Rich Howe discussed here last week, will be one of them. Healthcare has been really beaten down, so biotech, med tech, those are really undervalued right now. It's not like the sector's stopped growing. Electric vehicles, those are still growing, as we've seen from BYD. BYD is the Chinese company, that's the ticker symbol. And Tesla and other smaller companies. I think those will get going again. But yes, some of the familiar names from the last bull market, I think will resurface once the bull market starts up again. But the next big thing, could be quantum computing. Could be right.
Yeah, check in 5 years from now, and you'll figure it out. Like I said, I think that's economically transformational, but it's not actionable right now.
Yeah.
In the more near term, look for some more of those beaten down growth sectors that are still primed for success. I do think that we need to move on to our guests. We've spent maybe a little bit more time.
First, before we get to them, we got to update our. It's been a month since we picked stocks with Tyler London, our small cap and Cabot Early Opportunities editor, and Mike Santolo. They both came on a month ago, and we each picked one stock for the next month. I have the results before we get to Andy Crowder, our guest today. In a landslide, Tyler London wins with Duolingo, Duolingo, up 22% in the last month. Can you guess the rest of the order?
Let's go Mike, and then you, and then me.
Close. Me with BYD, I just mentioned it, BYD-DY, the Chinese electric vehicle giant, up 5.1% in the last month. Mike, close. Uber, you've heard of it, 4.3%. The only one that was negative is yours. Novo Nordisk, stock I like, company I like, down 4.3%. So
Yeah, there's a reason I don't have a paid advisory.
Well,
Like I'm talking to you for free on a podcast for a reason, Chris.
yeah, there's no real consequences here other than the people who said, "Hey, I'll buy that for the next month." You could, a month from now, it could be a totally different order. Maybe you'll be in first. So it's pretty true.
And Duolingo is one that was a beneficiary of that AI hype cycle as well.
Mm-hmm.
They talk about integrating AI models, and we talked about that when it came up, when Tyler brought it up, I believe.
Yeah.
So yeah,
yeah.
Credit to the three of you. Well done.
Mostly to Tyler.
Yeah, mostly to Tyler.
Yeah. I'll let you introduce today's guest.
Yep. So today we're going to bring on Andy Crowder, Chief Analyst of Cabot Options Institute, which has 4 advisories, and Options Institute Master Club that gives you access to all of those. And we are going to talk options. Andy, welcome.
Hey everyone, yeah, quantum mechanics and options, Quidditch. I'm not sure what.
Yeah, I think Quidditch is what he meant to say.
Our most accessible podcast ever. We talk quantum mechanics and option strategy.
Yeah, exactly.
And those are very good gains by Tyler. My daughter actually uses Duolingo, so
oh really?
Yeah, 22% in a week, or I should say a month. Not too shabby.
Pretty good.
So
yeah.
While we're on the subject of returns, though, Chris, you have a rundown, right?
Yeah, let me give a rundown. There's a reason we had Andy on today. So as we mentioned, Andy runs our Cabot Options Institute advisories, of which there are 4. But let me go through the returns. So Andy, you launched pretty much exactly a year ago.
Yes, 1 year ago.
1 year ago. In your quant trader service, speaking of quant, there's that word again. You have 29 out of 33 winning trades, 88% win ratio, total return 143%. In income trader, 39 out of 46 winning trades, 84.5% win ratio, total return 90%. Earnings trader, 22 out of 29, 75% win ratio, total return 49%. So those 3, and then your fundamentals, you're in the black too there. Your fundamental service, all of which have outpaced the S&P in the last year, which is up like 1% or something. How do you do this? Tell us your approach. And you have a very unique options approach. How are you making money for people in this market?
I wish that I could take all of the credit, but I will say that, and you've heard me say this many, many times, kind of probability statistics lead the way. I'm simply just following those laws of statistics, applying the appropriate option strategies. And thankfully, we've had a lot of success over the past year. It's certainly helped to, I guess, right around a year ago, I wrote an article for the Cabot Wealth Daily talking about the volatility bull market. And typically these volatility bull markets last anywhere from 5 to 7 years. And how I had thought that we were just entering into that, or had been for a few months. And having that heightened volatility certainly has helped all of our strategies as well, because we're able to sell options for a significantly higher price than we are otherwise. That being said, 43% of the time, the VIX is below 15. So there's always a need to sell those options regardless of what the volatility looks like. So that's that heightened volatility certainly has helped us for sure.
And what makes you sort of different? So we have Jacob Mintz, who is our other long time options trader, who's really good at what he does, buying call, a lot of times buying calls. But you are on the other end of those trades often. You sort of act as the house, right? If we were using the casino metaphor, you kind of you go for Jacob, whereas Jacob goes for doubles, triples, home runs. You are more aiming for lots of singles and doubles, right?
I am a singles and doubles guy. I'm the Tony Gwynn of options trading, Rod Carew, whatever you want to call me. So yeah,
Ichiro for the young. Ichiro for the young. That's still even too dated. I don't even know what it would be now.
well, baseball in general. But
Yeah.
yeah, so that has certainly, led to, so yeah, going back, singles and doubles based purely on statistics. Jacob tends to, because he was a market maker, so he follows that volume and he's really good about pouncing on those opportunities. Whereas again, I kind of go back to that statistical approach where I'm making trades that have roughly, 80-85% probability of success. And I know these things ahead of time because that's the great thing about options now. It used to be that a lot of the platforms and things like that we have accessible to us today, we didn't have 15, 20 years ago. And if we had those costs were exorbitant. So now options have kind of opened up to everyone. We have commission-free platforms. We have platforms that are, basically the same as professionals. So this whole world of trading this way, where it's based purely on statistics, again, has opened up. Whereas before, it just wasn't available to the retail public. They didn't have these opportunities. So now that we have these opportunities, we can start using these strategies. So it takes a little bit of a different mindset. But the early adopters, from what I've seen, my subscribers, et cetera, they're typically, math-based. They have math-based careers, engineers, people like that. So yeah, I'm not sure.
The Quibbit familiar crowd.
Quibbit
crowd, yes.
Yeah. Yeah.
So I'm going to take a step back, just to sort of outline what how your strategies maybe are different from how listeners might be perceiving it or viewers might be perceiving it. So a lot of novice option traders consider it, they'll go into a position speculating on direction and time, right? You buy a call because you think a stock is going to go up before a certain time. You buy a put because you think a stock is going to go down before whatever the expiry date is. Those are the doubles, singles, home run sort of hitting trades, right? In most cases, if somebody makes 140% in an option trade, it's probably because they're long a call or a put and there's a big price movement in the underlying. Those are great when you can get them, but those are tough trades to make. What Andy's doing is he's using mathematical probabilities with spreads, predominantly calls, puts. So selling I'll let you roll out a specific trade, but using spreads and then using what the options pricing is telling you about the probability of the underlying security going to a specific price, and you're capturing that excess return. You're selling sort of insured insurance because you've got a second leg that's covering your worst case scenario, right? But then you're selling that lower put if you're selling a put spread, for instance.
Yeah. So going back to, since you mentioned insurance company, I'll go back to the question that Chris asked that I did not answer. Everything that I'm doing, I act as the casino, I act as the insurance company. It's all based on mathematics, as you pointed out, Brad. So if I'm doing a spread, let's say we have an underlying stock that's trading for $100. Well, we know going into that there's something called the expected move. So the market's telling us based on supply and demand what that expected move should be over a specific time frame. Now, let's say it's 45 days. So what I'm trying to do is place a trade outside of that expected move, whether it's to the upside or to the downside. And typically, by placing those trades outside of that expected move, again, going out roughly 30 to 60 days, I'm able to place a trade that has roughly 85% probability of success. So over time, I know, due to the law of large numbers, that I will be successful. The problem is that a lot of people, we're in this mentality right now where it's like, I want profits today. I get emails from people, can you turn $250,000 into $500,000 over the next 6 months? I can't do any of those things. What I can do is I can consistently make returns through really any type of market. And again, that's because I'm using probabilities, but more importantly, I'm not going for the fence. I am, again, just trying to simply hit singles and doubles and using those probabilities to my advantage. And that's the case with, the three services that we mentioned, that being earnings trader, quant trader, and income trader. But then I have another service called fundamentals, where that's also a little different in that I'm essentially, because I'm an options trader. I'm not a I shouldn't say I'm not a long-term investor. I am a long-term investor, but picking stocks is not my forte. I rely on those at Cabot to do those types of things. Therefore, I've created passive strategies. And essentially I've just copied David Swenson, the Yale Endowment portfolio, Ray Dalio's all-weather portfolio, Buffett's, value, etc. And this is the one service that a lot of people have kind of taken to, because a lot of people use covered calls. So they're accustomed to that. That's kind of an entry strategy for those new to options. Well, what happens is those covered calls, particularly if you're trying to buy a stock like Nvidia or Apple or another higher price stock, that can be capital intensive, and it doesn't allow for a lot of diversification. Therefore, rather than buying those types of stocks and paying 100 shares just so I can sell one call against them, I'm going out and I'm buying what's known as a LEAPS contract. So I go out, it's an options contract, I go out 2 years, and it's typically 65 to 85% cheaper than buying those shares. So not only is it cheaper, but it also allows me to diversify. And then I can sell calls against those LEAPS, essentially using a covered call strategy. But rather than having those physical shares, I'm buying a LEAP and then selling those calls against those shares. And we've had a lot of success in those passive strategies. Again, this past year has proven how powerful those passive strategies are, like Swenson's and Dalio's portfolios, and how they've kind of stood the test of time. And that's kind of the camp that I fall in.
Yeah, it just to put a finer point on the context of it, you mentioned that you're sort of directionally agnostic. S&P is up 2.4% in the last year, with half of those gains coming today. So the fact that you have multiple services with double or even triple digit returns in what has been in its best conditions, sort of a choppy market, is really a remarkable testament to the principles that you employ.
I'll give those returns again real quick. 143% in quant trader, 90% in income trader, 49% in earnings trader in the last year. When you said, as you said, Brad, the 2.4% the S&P is up.
Well, it's good. It's certainly been a good test, particularly for those that don't believe in option selling, although I don't know many of those, at least those that have tried it. Because when I first started a year ago, I think the S&P was right around 4,100, and then it collapsed down to roughly 3,600 in August, or no, in August.
October.
In August, it shot up to 4,200, right around where it's trading now. And then, as you said, Chris, in October, we came back down to right around 3,600, and then we've seen nothing but higher markets. So we've seen a little bit of everything in this market. And throughout this past year, the one constant has been that volatility, and it's been fluctuating. Now it's at its lowest levels that we've seen in quite some time. But again, these volatility bull markets tend to last anywhere from 5 to 7 years. And people have been selling options they sell options every single expiration cycle. So it's not, even if we have a lower volatility, like I said before, 43% of the time the VIX is below 15. Well, people are still selling options. An 85% probability of success is still an 85% probability of success. Those probabilities don't change regardless of the market. Those expected moves and those volatilities will change, but the probabilities themselves do not change. So yeah, it's been a good year, for sure. And it's been a good test through all these different types of markets, how these strategies actually work and how well they work in these types of situations. And again, as you said earlier, Brad, I'm not making 140% on one trade. I'm not I'm not even coming close to that. It's 8% here, 10% here, 15% here, 6% here, and those just continue to stack up.
Well,
But go ahead.
It's the Moneyball thing, right? It's get on base, right?
Totally.
If 85% of the time you get on base, you're putting up 3-4 runs an inning, just legging out singles or getting hit by a pitch or whatever. Now,
Yeah, I mean, it's Moneyball, it's sabermetrics, it's all of those things. It's just pure statistics, and there's a reason why quants have kind of, there. When I first started on Wall Street, it was me and another guy. No one cared about, what we had to say. We were the only two people on Bloomberg, on the Bloomberg terminal, looking at option stuff. No one cared about options. They weren't really accessible, as I said before. That has completely changed. Options are the fastest growing and have been a segment of finance, and they will continue to be because more and more people are starting to understand, holy moly, I can, use these in a variety of different ways. Not only can I hedge my portfolio, but I can use this for income, or I can enhance a return. There's so many different ways. And, it kind of goes back to Jacob and I are both very successful at what we do, but we have two completely different approaches. And it goes to show that, it's not about one strategy. It's about applying those strategies but more importantly, using proper risk management. And that's the one piece that I think bothers me about this industry, is that a lot of people will hype up their gains and things like that. But what they don't tell you is that, yeah, those losses will come. How are we going to attack those losses? How do we, hedge our positions so that our losses aren't as great when they do come? And I look at myself more as a risk manager and a trader first and a trader second. And I feel as though everyone should do that. That really takes this seriously if they want to be successful over the long term. And I really hit home to my subscribers just how important that risk management is.
Yeah, there's a saying that my trader buddies and I used to use: bulls make money, bears make money, pigs get slaughtered, or hogs get slaughtered, right? That one sticks with me. You can have strategy variance, as a variety of strategy, as long as you consistently employ it, and you can ultimately be a successful investor, even if you're on the other side of a trade from somebody like Jacob, for instance, right?
Right. Yeah, and I mean, that's kind of the whole purpose of the Cabot Options Institute, that Masters Club, having these 4 services. While you can use them individually, and they're 4 completely different approaches, the reason why I created those 4, particularly for that Masters Club, is because they're supposed to be used in unison, simultaneously. So they're kind of working off of each other. Some do better during bear markets, some do better during bull markets, some do better during heightened implied volatility. And everything in between. So having that mix coupled with a disciplined style of risk management is a recipe for success over the long term. Of course, there's many, many other challenges, but that's certainly a starting point.
Yeah, and as Andy mentioned, the Cabot Options Institute newsletters, they're available on the cabotwealth.com website under premium advisories. You could get all 4 by subscribing to Cabot Masters Club, or you can sign up for any one of the 4 he just mentioned: earnings, income, quant, or fundamentals. And also, if you want to hear more from Andy about all things his strategy and options, he is doing a webinar. He and I are doing a webinar together next Thursday at 2 p.m. Eastern. The title of the webinar is How I Won 87.5% of my trades in the last 12 months. In fact, I think the percentage is higher now. We've created that title before you did a couple more successful trades. That's next Thursday at 2. It's free. And so, yeah, please join us for that. Before we let you go, Andy, I got to bring in Madison Robertson, our producer, who I failed to introduce earlier. Is this the most math you've heard since you were in college, high school? And had you ever heard of the term quivets?
Yes, because I didn't really do a lot of those classes. I tried to dodge as many of those mathy, sciencey classes as I absolutely could. So I think I got even more actually than I did in high school and college. And also what word?
Quibbits. It's okay if you tuned it out. That's probably. I think I kind of did subconsciously too.
How do you
Brad mentioned
spell
Quibbit.
that?
I
how do
think
you spell it?
Ribbit. I think is how you spell it, or maybe it's Andy said it might be Quidditch. It's fine.
Qubit.
Qubit. Yeah, that's the next big thing in the market. Brad thinks so. Look out for.
Okay.
Yeah.
All right. Well, you guys are very quickly learning to tune me out. It took my family a decade to figure that one out. Podcast co-hosts figure it out in 2 months. Listeners will figure it out in 6.
Yeah.
So
I think Madison figured it out even before started.
Before we started.
Yeah. Andy, thanks for joining us. And again, people interested in signing up for our Cabot Options Institute, it's on the cabotwealth.com website. Brad, any last comments or questions for Andy before we say goodbye?
No, I do fully endorse attending the webinar, though, if you're at all even intrigued by the strategy, because we are limited in our time and ability to go deep into the strategies that he employs. So if it piqued your interest, sign up for that webinar, because you'll learn a lot. Andy is great at being really transparent with his subscribers and his readers. So it's more of a teaching relationship even than an advisory relationship. He wants people to understand why the systems work the way they do and how to implement them successfully. So tune in if you're interested at all.
Yeah, and it's free. Thanks everyone for joining Street Check today. Again, as always, give us a like if you're watching on YouTube. Hit that like button, subscribe, give us a 5-star rating. It all helps get the podcast keeps the lights on, basically. So thanks again for tuning in today, and we'll see you next Friday for another edition of Street Check.